Imagine this, a single decision right at the start of your business, maybe even before you properly open your doors.
Mm,
And that one choice could literally save you hundreds of thousands, maybe millions, in taxes over the years.
or cost you that much if you get it wrong.
Exactly. Or
Yeah.
cost you a fortune. We're talking about, well, the fundamental choice of how you structure your business. Welcome to the deep dive. We take complex stuff, piles of information, and distill it into insights you can actually use.
Right.
Today, our mission is navigating the world of business entity taxation. It's often overlooked, but it's so critical. You've shared some really comprehensive source material, and we're going to pull out the most important nuggets. We're focusing on those strategic tax-saving methods, the ones that empower you to make truly informed choices.
Absolutely. And understanding this dance between the legal structure and the tax implications, it isn't just about compliance, checking boxes.
Right.
It's really about maximizing your financial efficiency right from day one. We'll unpack the why behind certain choices and, crucially, highlight where those significant tax advantages lie. We want to help you minimize that tax bill.
Keep more of your hard-earned money.
That's the goal.
Yeah.
Understanding the foundation,
Right.
business entities and their tax identities.
Okay, let's unpack this then. When you set up a business, you're not just, picking a kitschy name.
No.
You're choosing its legal outfit, right? Its
Yeah.
public identity. But here's where it gets interesting. There's this crucial layer beneath the surface.
Often hidden.
Yeah, it's tax identity. Why is it so vital to think about both, not just the legal side?
Well, what's truly fascinating here is this duality. You have these different legal entities, sole proprietorships, partnerships, LLPs, LLCs, C Corp, S Corp.
The whole alphabet soup.
Pretty much. And they all have very distinct legal characteristics. Things like, how many owners, the setup formalities, crucially, owner liability, are your personal assets protected?
That's a big one for most people.
Huge. And then there's a management structure, how easily you can transfer ownership. So, legally, a sole proprietorship, super simple to form, right? Maybe no paperwork.
Right.
But boom, unlimited personal liability. Your house could be on the line for business debts.
Yikes.
Yeah. Contrast that with, say, a C corporation. More formal setup, articles of incorporation needed.
More hoops to jump through.
Definitely. But in return, shareholders get that limited liability protection. Their personal assets are generally shielded. An S Corp offers similar protections, legally speaking, but it has strict rules, like only 100 shareholders max, and they have to be individuals or certain trusts.
Okay.
Then you've got partnerships. Need at least 2 owners, usually state filings involved. General partnerships often mean unlimited liability for everyone, though LLPs and limited partnerships offer variations. So legally, you're weighing risk, complexity, future plans for investors, or selling.
Makes sense.
But here's the kicker, and this trips up so many entrepreneurs. These legal structures don't automatically tell the IRS how to tax your business.
Ah, okay. So the legal suit doesn't always match the tax outfit, so to speak.
Exactly. They can be completely different.
So let's take the LLC. It's super popular, right, for that liability protection and
But
flexibility.
very popular.
But you're saying it's not actually one of the main tax categories the IRS uses. So how does it fit in? Does the IRS just, guess?
Not quite guess, but that's a great question. This is where the check-the-box regulations come in. And this is your first big strategic decision point, tax-wise.
Okay, check the box.
Right. For these unincorporated entities, like LLCs, the IRS assigns a default tax status based mainly on the number of owners.
A default.
Yep. So if an LLC has 2 or more owners, the default is partnership. It files a Form 1065, income flows through to the partners.
Okay, simple enough.
If it's just one owner, and that owner's an individual, the default is Schedule C sole proprietorship. It just goes on your personal 1040.
Right on your personal return.
And if the single owner isn't an individual, maybe it's another corporation, its income or loss just gets rolled into that owner's return.
Okay, so there's a default. But you mentioned strategy.
Yes. Here's the power.
Yeah.
That LLC, or any unincorporated entity, can elect a different tax status. It can choose to be taxed as a C corporation, file Form 1120, even with just one owner.
Really?
Yes. And if it qualifies, remembers those S Corp rules, like owner limits.
Mm-hmm. The 100 shareholder thing?
Right. If it meets those, it can even elect to be taxed as an S corporation, filing Form 1120S.
Wow.
This check-the-box election power is your first major opportunity for strategic tax planning. You can pick the legal structure you want for liability, and then pick the tax structure that saves you the most money.
That's a huge distinction. Okay, so this deep dive is all about finding those spots where the entity choice really hits your tax bill.
Exactly. Finding the levers you can pull.
We're focusing on 7 key areas from the sources, places where these differences really matter for saving tax. First, how contributions are taxed, especially appreciated property. Can you put assets in tax-free?
Crucial at the start.
Second, how the business income itself gets taxed. Single tax, or that dreaded double tax.
The core issue for many.
Third, deducting business losses. Super important for startups, right? Can you use those losses now?
Immediate benefit or delayed.
Fourth, how owners get paid salary, distributions, and the tax hit, like FICA or self-employment tax.
Big impact on take-home pay.
Fifth, taking money out while you're still operating distributions, taxable or not.
Right. Cash flow implications.
Sixth, when you close up shop liquidating distributions, what's the tax cost of shutting down?
The exit strategy tax.
And finally, even changing your mind, converting from one entity to another. What's the tax cost there?
Can be surprisingly high sometimes.
Each one of these is an opportunity for smart planning, potentially saving you a lot on taxes.
That's the plan. Dig into each one. 2. Smart moves from day 1. Tax implications of property contributions.
Okay, let's zoom in on day 1. You're starting out, you're putting assets into the new business. Maybe it's cash, maybe it's a building, maybe a patent you own.
Right. Capitalizing the venture.
You get ownership, stock, or partnership interest in return. Here's where it gets really interesting, potentially scary. Just contributing that property trigger a surprise tax bill.
Yeah.
Especially if it's worth more now than when you got it.
It absolutely can. It's a common pitfall if you're not careful, particularly with corporations.
Okay.
For C and S corporations, the general idea is that contributing property for stock can be a non-taxable exchange.
Sounds good, right?
No immediate tax.
Sounds great.
But, and it's a big but, this only works if you meet the very specific, quite strict requirements of Internal Revenue Code, Section 351.
Section 351.
Okay. The IRS basically says, okay, tax-free is fine, but only if it's truly just changing the form of ownership, not like a disguised sale.
Got it. So what are the rules?
There are 3 main conditions. First, you have to transfer actual property. Cash counts, patents count, buildings count. Services generally don't.
Okay, property, not services.
Second, it has to be solely in exchange for stock in that corporation, not other things like debt instruments from the corp.
Just stock.
And third, this is the big one. The people transferring property, the transfers, must collectively have at least 80% control of the corporation immediately after the exchange.
80% control. That sounds high.
It is. It means 80% of the voting power and 80% of the total shares of all other classes of stock. If you and your co-contributors don't hit that 80% mark right after the transfer,
Then what?
then gain or loss is recognized by the shareholders on their appreciated property. You could owe tax right then and there before the business even makes a dime.
Ouch. A tax bill just for starting up?
Exactly. A potentially costly mistake right out of the gate.
So that Section 351 sounds like a pretty significant hurdle for C and S Corp. What about partnerships? Is it just as tough?
This is where partnerships really shine, contribution-wise. It's much simpler, much more flexible.
So?
Unlike corporations, there's no 80% control requirement for partners contributing property for an ownership interest.
No.
Nope. You could contribute property for just a tiny 1% partnership interest, and it still generally qualifies as a non-taxable exchange under the partnership rules.
Yeah, that's a big difference.
Huge difference. It makes forming a partnership with diverse property contributions much easier tax-wise. You avoid that immediate tax trigger. The partner's basis in their interest is just their basis in the property they put in, adjusted for liabilities, and the partnership takes the property with the same basis. Much cleaner.
Okay, that sounds way less risky for appreciated property.
Definitely. And what's also fascinating is how partnerships handle built-in gains or built-in losses.
Built-in gains, what's that?
That's the appreciation or depreciation that happened before the property went into the partnership. Say you put in land you bought for $50K, but it's worth $100 now. That $50K difference is the built-in gain.
Got it. Pre-contribution value change.
Exactly. Now, if the partnership later sells that land, say for $120K, that first $50 of gain, the built-in part gets allocated specifically back to you, the contributing partner.
So I pay tax on the gain that happened on my watch.
Precisely. It prevents shifting your pre-contribution tax burden to the other partners. The gain that happened after contribution, the extra $20 in this example that gets allocated among all partners based on your agreement.
That seems fair.
It's designed to be equitable.
So, boiling it down, if you're putting appreciated property into a new business, what's the takeaway? Which structure helps avoid that immediate tax hit?
This characteristic, the tax treatment of contributions, clearly leans towards the partnership or sole proprietorship.
Why sole proprietorship, too?
Because for a sole prop, putting assets in or taking them out isn't really a taxable event. It's just moving your own assets around. And for partnerships, you avoid that complex Section 351 control test that trips up corporations. Almost any property for interest swap is tax-free. This is a huge tax saving right at the start, keeps your capital intact, delays the tax bill. A key nugget for setup.
Definitely a smart move from day one to consider. 3. The heart of the matter. How business income is taxed and how to optimize it. Okay, now for the main event, really. How the money your business actually earns gets taxed. This hits the bottom line directly.
Absolutely. This is where ongoing tax efficiency comes in.
Let's start with C corporations. We hear this term all the time, double taxation. It sounds bad. What exactly does it mean for your money?
It means exactly what it sounds like, unfortunately. C corporation income gets taxed twice.
Twice. How?
First, the corporation itself pays tax on its net income. It's the only entity type where the business itself pays income tax directly. Currently, that's a flat 21% federal corporate rate. That's layer 1.
Okay, 21% off the top for the corp.
Right. Then, when the corporation distributes its after-tax profits to shareholders as dividends, that same income gets taxed again at the shareholder level.
The second hit.
Yep. For individual shareholders, qualified dividends get taxed at capital gain rates. Could be 0%, 15%, or 20%, depending on your overall income.
So 21% plus potentially 20%.
Potentially, yes. And for higher income folks, there's potentially another sting.
Oh.
There's the 3.8% net investment income tax, the NII tax. If your adjusted gross income is over a certain threshold, like $200 K single, $250 K married filing jointly, you might owe that extra 3.8% on top of the 15% or 20% dividend tax.
Wow, so the combined rate could get pretty high then.
It can. That double hit can significantly reduce the net amount the owner actually keeps compared to other structures.
Yeah, sounds like if a C Corp makes money and pays it right out, your wallet takes a double hit. Is there any way around that? Or maybe situations where it's not so painful?
There is a key strategy. It's about retaining earnings.
Keeping the money in the business.
Exactly. If the C corporation holds onto its profits instead of paying dividends, that second layer of tax, the shareholder dividend tax, is delayed.
Deferred, basically.
Right. It doesn't trigger until dividends are actually paid, which could be years later, or maybe never if it's reinvested into liquidation. This can be really advantageous if the business needs capital for growth, expansion, paying down debt, and the owners don't need the cash personally right away.
So you just pay the 21% corporate tax for now?
For now, yes. It allows more capital to stay and compound within the business. Makes the C Corp a viable choice when reinvestment is the top priority.
Okay, now let's flip the coin. The alternative. Single taxation. Sounds much better. How do these flow-through entities achieve that?
Right, flow-through or pass-through entities. This includes your Schedule C sole props, partnerships, S corporations, and most LLCs, the ones taxed as partnerships or sole props by default or election.
Okay.
With these, the business entity itself doesn't pay income tax, zero entity-level tax, none. Instead, the income, the losses, the deductions, they all literally flow through the entity directly to the owner's personal tax returns each year when the income is earned.
Whether you take the cash out or not.
Exactly. Doesn't matter if it's distributed. The income is taxed just once on the owner's 1040 at their individual ordinary income tax rate.
And those rates vary a lot, right?
They do, from 10% up to 37%. So depending on your personal tax bracket, this could be higher or lower than the C Corp's flat 21%. That's a key calculation.
Right. And if there are multiple owners, like in a partnership or S Corp?
Generally, the income and deductions are allocated based on ownership percentage. Own 60%, you get 60% of the income or loss on your return.
Makes sense.
But partnerships offer extra flexibility here. The partnership agreement can actually specify different allocations, maybe based on capital contributions or who does what work. It's a strategic tool partnerships have that S Corps don't.
Interesting. Okay, beyond just income tax, there's another big one. Self-employment tax, Social Security and Medicare.
FICA for employees, SE tax for the self-employed. It's a big chunk.
Who pays it? And crucially, can your entity choice help you minimize or even avoid it?
This is a huge differentiator. Self-employment tax is generally 15.3% on technically 92.35% of your self-employment earnings.
Ouch.
Yeah. For a sole proprietor, that SE tax applies to your entire net business income from Schedule C.
All of it.
All of it. For partnerships, general partners who are active in the business pay SE tax on their share of the business income and also on any guaranteed payments they receive for services.
Okay, active partners pay it.
Right. But here's the golden nugget for S corporations, a major reason they're so popular.
Okay.
Business income that flows through from an S corporation is generally not considered self-employment income for the shareholders.
Not at all, even if they work there.
Not the flow-through income. Now, if you're an S Corp shareholder and you actively work for the business, you must pay yourself a reasonable salary.
Okay. A salary.
Yes, and that salary is subject to regular FICA taxes, just like any employee. The corp pays half, you pay half via withholding.
Right.
But any profit beyond that reasonable salary, the stuff that just flows through as business income or is taken as distributions, that part is not subject to SE tax.
So you'd save the 15.3% on that chunk.
Exactly. Compared to a partnership or sole prop where all active income gets hit, this can lead to significant tax savings, especially for profitable businesses. It's a major optimization point.
That's huge. What about that other tax, the net investment income tax, the 3.8% one? Does that apply to flow-through income?
It can, but only under specific circumstances. Remember, it applies to investment income for higher income taxpayers.
Right.
So for partners in a partnership or shareholders in an S corporation, if you are not actively involved, if you're a purely passive investor, then your share of the business income is considered passive or investment income.
And therefore subject to the NII tax.
Potentially, yes, if your overall income is above those thresholds, 200K or 250K AGI. But if you are actively involved, materially participating, then your share of the income generally isn't considered investment income, so no NII tax on that.
And sole props.
Sole prop income is considered self-employment income, not investment income, so it's generally not subject to NII tax.
Okay, got it. Now, there's this other deduction we hear about, the QBI deduction, Section 199A.
The qualified business income deduction.
That sounds important. What is it and who gets it?
It's a major tax break, fairly recent, designed specifically for owners of flow-through entities.
Only flow-throughs.
Only flow-through. So partners, S-Corp shareholders, sole proprietors. It allows them to deduct generally 20% of their qualified business income.
20%? Wow.
Yeah. It's a deduction taken right on your individual return form 1040. It directly reduces your taxable income. So if you have $100,000 of QBI, you might get a $20,000 deduction.
That's substantial.
Very. Now, there are limitations based on your taxable income, the type of business. Specified service businesses like doctors, lawyers, accountants face stricter limits.
Okay, some complexity there.
Yes, but for many businesses, it's a straight 20% reduction. And crucially, C corporations do not get this deduction.
So another win for flow-throughs.
Absolutely. It significantly lowers the effective tax rate on business profits for many owners, making flow-through structures much more attractive from an income tax perspective post-tax reform.
Okay, so putting it all together, double tax versus single tax, SE tax, QBI deduction.
Yeah.
How do you actually choose the best entity for income tax? It sounds like. It depends.
It absolutely depends. There's no single best answer. It boils down to two key factors, really.
Okay, what are they?
First, compare the owner's individual marginal tax rates to the C Corp's flat 21%. Are you personally paying more or less than 21% at the margin? Factor in the QBI deduction for flow-throughs, too.
Right, your personal bracket versus the corporate rate.
Second, and just as important, what's the plan for the profits? Are you going to reinvest everything back into the business or distribute it out to the owners?
Retain versus distribute.
Exactly. If the plan is to retain earnings for growth, the C corporation might be better, especially if the owners are in high tax brackets. You pay only the 21% corporate tax now, and you delay that second layer of dividend tax. More money stays in the business working for you.
Okay, retain favors, C Corp, maybe.
Maybe. But if the plan is to distribute profits regularly as dividends, or if the owners are in lower tax brackets where their rate plus the QBI benefit beats 21%, then a flow-through entity is usually more advantageous. You avoid double taxation, and the QBI deduction provides a nice bonus.
It's a calculation based on specifics.
It is. Let's run a quick example. Don and Mary, equal owners, starting a business, expecting big profits, both working in it actively. Plan is to reinvest everything. No distributions, no compensation for a while.
Okay. Scenario 1. Don and Mary are in the lowest individual tax brackets.
Okay. Low brackets, active, retaining earnings. Here, an S corporation is likely best.
Why S Corp?
It's flow-through, so income is taxed at their low individual rates, which are below the C Corp's 21%, they also get the 20% QBI deduction. Since they're reinvesting, double tax isn't an immediate issue anyway. Why not partnership? Because as active partners, they'd pay the 15.3% SE tax on all that income. With an S Corp, that flow-through income avoids SE tax. S Corp wins for low-bracket active owners retaining earnings.
Got it. Scenario 2. Same facts, but Dawn and Mary are in the highest individual tax brackets.
Okay, high brackets, active retaining earnings. Here, a C corporation is probably most advantageous.
Why C Corp now?
Because the business profits will be taxed at the flat 21% corporate rate. If it were flow-through, that income would hit their personal returns at their highest marginal rate, maybe 37%. That's a big difference. Since they're retaining earnings, the second layer of dividend tax is deferred. They benefit significantly from the lower corporate rate on retained profits.
That really drives it home. Your personal tax rate and your distribution plans are absolutely key.
Paramount. No one-size-fits-all answer here. 4. Navigating losses. Turning red ink into green savings.
Okay, let's talk about the flip side of profits. What if your business loses money, especially in the early years? Many startups do.
Very common. Startup costs, getting established.
Can those losses actually, save you money on your personal taxes right now, or are they just stuck in the business?
This is a huge advantage for flow-through entities. The ability to take business losses and use them on your personal return to offset other income like from a job or investments is a major reason people choose S-Corp, partnerships, or sole props.
So you get an immediate benefit.
Potentially, yes. If you have enough basis, basically enough skin in the game financially, and you're actively involved, those losses flow through and can reduce your overall taxable income for the year. This could mean a bigger refund or lower tax bill right when cash flow might be tightest.
That sounds really helpful for a startup. What about C corporations?
C Corp losses are different. They get trapped at the corporate level. They create net operating losses, or NOLs. Right. These NOLs can only be used by the corporation itself and only carried forward to offset future corporate profits.
So no immediate personal tax break.
None. And even when the C Corp does become profitable later, those NOL carry-forwards can only offset up to 80% of that future year's income. The benefit is delayed and potentially limited.
Doesn't sound as good for early years.
Generally not. Flow-throughs offer that immediate potential benefit. And even if flow-through losses get temporarily suspended due to basis limits or other rules like passive activity loss rules,
they're not gone forever.
No, they carry forward personally, and importantly, they aren't subject to that 80% limitation that C Corp NOLs face. More flexibility down the road.
You mentioned sufficient basis being key to deducting losses. What exactly is basis, and does one type of flow-through give you more of it?
Think of basis as your investment tracking account for tax purposes. It starts with what you contribute, goes up with income and more contributions, goes down with losses and distributions. You generally can't deduct losses beyond your basis.
Okay, it limits your loss deductions.
Right. And here's where partnerships often have an edge over S corporations.
How so?
A partner's basis in their partnership interest includes their share of the partnership's debt.
The business's loans increase the partner's personal basis.
Generally, yes, subject to certain rules, at-risk rules, etc. But if the partnership borrows money, that debt allocation can increase the partner's basis, giving them more capacity to deduct losses that flow through.
And S-Corp.
S-corporation shareholders do not get to include the corporation's debt in their stock basis. If the S-Corp takes out a loan, it doesn't help the shareholders deduct more losses via stock basis. Now, if a shareholder personally loans money to their S-Corp, that loan creates basis, but that's different from including entity-level bank debt.
So partnerships generally allow for bigger potential loss deductions because of including entity debt in basis.
Often, yes. That higher basis ceiling can be a significant advantage, especially if the business is leveraged and expecting early losses.
Okay, let's revisit Dawn and Mary. Starting their business, contributing significantly, actively involved, expecting losses for a few years, but they have other income, middle tax brackets.
Right. Losses expected, other income to offset, active participation, good initial basis.
What's best for them loss-wise?
In this scenario, either an S corporation or a partnership would be much better than a C Corp.
Flow-through is key.
Absolutely. The losses pass through to Dawn and Mary personally. Since they have other income, they can potentially use those losses immediately to reduce their personal tax liability. They're active, so passive loss rules likely won't bite. They have basis. It's an immediate tax benefit.
Which a C Corp just can't provide in year one.
Correct. The C Corp loss stays with the Corp. This immediate use of losses and flow-throughs is a powerful tool for startups, helps cushion the financial blow of those early years, turns that red ink into, well, green tax savings on their 1040s.
A very tangible benefit. V, compensating owners. Maximizing tax efficiency. All right, let's talk about getting paid. You're working in the business, you deserve compensation. But how you take that money out? Salary, guaranteed payment, distribution has big tax consequences, right? Especially for those payroll taxes.
Huge consequences. It directly impacts your FICA or self-employment tax burden, which is a significant cost. This is a really important area for optimization.
Okay, break it down for us. How does it work for different entities? Let's start with corporations.
For C and S corporations, owners who work in the business are treated as employees, so they can be paid a salary.
Like a regular W-2 employee.
Exactly. That salary is ordinary income to them. The corporation pays the employer's share of FICA taxes, half of the 15.3%, and the employee pays the other half through withholding.
Okay.
Crucially, the corporation gets to deduct both the salary paid and the employer FICA taxes it pays.
So a deduction for the business.
Yes, reduces the corporation's taxable income. That's good.
Okay, what about partnerships? Can partners be employees?
No, that's a key difference. Partners cannot be employees of their partnership.
So no salary.
Not technically.
Yeah.
Instead, partners who provide services often receive what are called guaranteed payments.
Guaranteed payments, okay.
The partnership can deduct these guaranteed payments, similar to a salary expense, but since partners aren't employees, the partnership does not pay the employer share of FICA.
Uh-oh. So who pays it?
The partner does. The guaranteed payment is ordinary income to the partner, and it's considered self-employment income. That means the partner pays the entire 15.3% self-employment tax on that payment themselves.
Ouch. That's a bigger hit on the partner personally.
It is. No cost sharing on the SE tax, like with corporate salaries.
And sole proprietor.
Sole proprietor is the business. They can't pay themselves a salary. All the net profit from the Schedule C is just considered self-employment income.
And subject to the full SE tax.
Correct. They pay the full 15.3% SE tax on their entire business profit up to the Social Security limit.
Okay, so salary treatment in core seems generally better for FICA's tax. What about other benefits like health insurance, retirement plans?
Another area with big differences, especially health insurance. This is where C Corp often have a distinct advantage.
How? So for C Corp?
In a C corporation, qualifying fringe benefits like health insurance premiums paid for shareholder employees are deductible by the corporation. That's good.
Reduces corporate tax.
Right. And even better, those benefits are generally non-taxable to the shareholder employee receiving them.
Tax-free benefits.
Yes. The C Corp gets a deduction and the owner gets the benefit tax-free. That's a powerful double win.
Wow. What about S corporations? Same deal.
Not quite. It's more nuanced for S corporations.
Yeah.
The S Corp can deduct the cost of fringe benefits like health insurance. That part's similar.
Okay.
However, whether the benefit is tax-free to the shareholder employee depends on how much stock they own. If you own 2% or less of the S Corp stock, the benefit is generally non-taxable, like in a C Corp. But if you own more than 2%, which most owner-operators do, then the value of those fringe benefits is typically taxable income to you.
So the S Corp gets the deduction, but the owner pays income tax on the benefit.
Generally, yes. It's usually added to their W-2 wages. It avoids SE tax, but not income tax for those greater than 2% owners. That 2% threshold is a really important catch for S Corp.
Definitely. And partnerships. How are benefits treated for partners?
For partnerships, fringe benefits paid for partners are usually treated like guaranteed payments, meaning they are deductible by the partnership, but they are taxable ordinary income to the partner receiving the benefit, and potentially subject to SE tax as well.
So no tax-free benefits for partners either?
Generally, no. The C Corp's ability to provide tax-free fringe benefits is pretty unique among the common structures.
Okay, putting compensation and benefits together. If you want to pay yourself a decent amount and get things like health insurance covered tax efficiently, which entity looks best?
Well, connecting the dots, both C and S corporations generally have an advantage over partnerships on the salary part because the corporation deducts its share of FICA payroll taxes.
Right, the partnership doesn't pay that employer share.
Exactly. But when you factor in fringe benefits, the C corporation often emerges as the most advantageous overall.
Because of the tax-free benefits.
Precisely. That ability to provide qualifying fringe benefits like health insurance, completely tax-free to all shareholder employees, is a major plus. S-Corp only offer that to small owners, and partnerships make benefits taxable to partners.
Let's bring back Don and Mary one more time. Active owners, middle brackets, want reasonable compensation and health insurance paid by the business. No other distributions needed for now.
Okay. Active middle bracket needs salary and benefits, retaining other profits.
So what's the play?
Here, the C corporation looks very strong. The corp pays them salaries, deducts the salaries, pays and deducts the employer FICA. Crucially, it pays for their health insurance, deducts that cost, and the benefit is tax-free to Don and Mary.
Best of both worlds there.
Pretty much. All these deductions reduce the C corp's income, which is then taxed at that 21% rate. If it were an S corp, the health benefits would be taxable to them since they own more than 2%. If it were a partnership, the guaranteed payments would trigger full SE tax for them, and the benefits would be taxable income too. The C corp provides the most tax efficiency for both salary and benefits in this common scenario.
Makes sense. The tax-free nature of C Corp benefits is a really powerful differentiator. 6. Distributions and liquidation. When the money moves and the tax bill appears. All right, let's shift gears. Your business is doing well, making money. What happens when you want to take some of that profit out, but you're not closing down, just an operating distribution?
Making some cash off the table or maybe some property.
How does the entity choice affect the tax bill on that move? Is it taxable? Does it matter if it's cash or property?
It matters hugely. The tax treatment of these operating or non-liquidating distributions varies dramatically. This is a critical area for planning how to access your business wealth.
Okay, start with the C Corporation again. How are distributions taxed there?
For a C corporation, distributions are generally treated as taxable dividends to the shareholders, but only up to the amount of the corporation's earnings and profits, or EMP.
EMP, like retained earnings.
Sort of a tax measure of accumulated income, yeah. So distributions up to EMP are dividends, taxed at those preferential capital gain rates, 0.1520% plus potential NII tax.
Okay, taxable dividends. What if they distribute property that's gone up in value?
That triggers tax at both levels again. First, the C corporation itself has to recognize a gain as if it sold the property for its fair market value, FMV. That gain is taxed at the corporate level.
Ouch. Tax on the way out.
Yes. Then the shareholder receives the property, and the FMV of that property is treated as a taxable dividend to them, taxed at their individual dividend rate. Double hit again on appreciated property distributions.
Doesn't sound great for appreciated property. How about S corporations? Are distributions simpler?
S corporation distributions are. Well, they have their own logic. It's often more favorable than C corp, especially for cash. The general idea is income that's already flowed through and been taxed to you personally shouldn't be taxed again when distributed.
Like taking money out of your tax savings account.
Kind of. Distributions are generally non-taxable first, to the extent of your basis from previously taxed S-Corp earnings. This is tracked in an account called the AAA Accumulated Adjustments account.
Okay, tax-free up to AAA.
Right. Then, if the S-Corp used to be a C-Corp, distributions might be taxable dividends from old C-Corp EMP. After that, they're non-taxable again as a return of your remaining stock basis. Only after all that basis is used up do distributions become taxable capital gains.
Bit of a waterfall effect there.
Exactly. But what about appreciated property? Similar to C Corp, the S corporation itself recognizes gain on distributing appreciated property. That gain then flows through to the shareholders' personal returns, increasing their taxable income and their basis before you apply the distribution rules.
So, still an entity-level gain recognition for S-Corp on property.
Yes. The gain flows through, but it's recognized.
Okay. Now, partnerships. How do they handle distributions?
Partnerships are generally the most tax-friendly for distributions, especially appreciated property.
How so?
Cash distributions are usually non-taxable to the partner unless the cash exceeds their basis in the partnership interest. Only the excess cash is taxed as capital gain.
Non-taxable up to basis. That sounds good.
Very good. And for distributions of property, here's the big win. Generally, no gain or loss is recognized by the partnership or the partner when property is distributed.
No gain recognized at all?
Generally, no. The partner just takes the property with a basis derived from their partnership interest basis. This avoids that immediate tax hit that corporations face when distributing appreciated property.
That's a massive difference.
It's huge. And what about a sole proprietorship?
Taking money or property out.
It's simply not a taxable event. You and the business are one for tax. Taking cash out is like moving money between your own pockets.
Right.
So looking at operating distributions, This tax characteristic clearly tends to favor the partnership form,
especially for property.
especially for appreciated property. No entity-level gain distribution amount is basis, not FMV, and generally non-taxable up to the partner's basis, which is often higher anyway because it includes debt. Much more flexibility to get assets out tax efficiently.
Okay, that's operating. What about the end game? You decide to close the business completely, liquidate everything, distribute all remaining assets.
The final curtain call.
What's the tax impact then? How does entity choice affect the tax cost of walking away?
The tax cost of liquidating is another crucial factor, and again, big differences emerge.
How do corporations handle liquidation? C and S.
For both C and S corporations, liquidation generally triggers tax at both levels, similar to distributing appreciated property during operations, but now it applies to all assets.
Both levels again.
Yes. First, the corporation, C or S, recognizes gain or loss on all its assets distributed, calculated as FMV minus adjusted basis. For a C Corp, that gain hits corporate taxable income. For an S Corp, it flows through to the shareholders. That's level 1.
Okay, entity-level tax on asset appreciation.
Then level 2. The shareholders recognize capital gain or loss on their stock. This is calculated as the FMV of everything they receive in the liquidation minus their basis in the stock.
So tax on the asset gains, then tax on the stock gains.
But essentially, yes. It can be a very tax-costly way to wind down a business holding appreciated assets.
Not ideal. How do partnerships liquidate? Any better?
Much better, usually, if assets have appreciated. For partnerships, generally, no gain or loss is recognized by the partnership itself on distributing assets in liquidation.
Again, no entity-level gain.
Correct. Huge advantage. Instead, the partners allocate their outside basis, their basis in the partnership interest, among the assets they receive. A partner typically only recognizes gain if the cash received exceeds their basis or lost only in specific, limited situations.
Much simpler, much less tax.
Generally, yes. For a sole proprietorship, again, liquidation isn't really a separate tax event. The owner just keeps the assets. Any gain or loss happens if and when they later sell those individual assets.
So for liquidation, who wins?
If the business holds appreciated property, the partnership usually wins hands down due to avoiding that entity-level gain recognition.
Makes sense.
However, if the business holds property that has decreased in value, lost property, corporations might actually be slightly better because they can recognize those losses upon liquidation, which might provide a tax benefit. Partnerships generally don't recognize losses on distribution.
Interesting nuance. Okay, Don and Mary again. Their business is rental real estate, expected to appreciate significantly. It's a passive activity. They're worried about the tax hit when they eventually sell or liquidate.
Okay, appreciated assets, passive activity, liquidation concern.
What's the best structure for their exit?
The partnership is the clear winner here. Because on liquidation, the partnership itself won't recognize gain on that appreciated real estate when it's distributed. Don and Mary will take the property with a carryover or substituted basis. They generally won't recognize gain either unless they get cash exceeding their basis. This avoids the double whammy of entity-level gain and shareholder-level gain they'd likely face with a C or S corporation. For holding appreciated assets long-term with an eye towards liquidation, the partnership structure offers significant tax advantages.
Avoids a potentially massive tax bill at the end.
Exactly. 7. Changing course. Entity conversions and their tax costs.
Okay, businesses evolve, right?
Right.
What worked at the start might not be the best fit 5 or 10 years later. Maybe your tax situation changes or your goals change.
It happens all the time.
So can you change your business entity type? And maybe more importantly, what's the tax cost of doing that? Is it easy to switch?
Good question, because flexibility matters. The ease and tax costs depend heavily on which way you're converting.
Okay. What about going from a flow-through entity like a partnership, S-Corp, or sole prop to a C corporation?
That direction is generally pretty straightforward and relatively tax painless.
How does it work?
An S corporation can simply file paperwork to revoke its S election, and boom, it's a C corporation going forward. Though remember, they usually can't switch back to an S corp for 5 years.
Okay, revocation for S-Corp. What about partnerships or sole props?
They have options. They can use the check-the-box regulations to simply elect to be taxed as a C corporation, or they can form a brand new C corporation and contribute their existing business assets into it, usually tax-free under that Section 351 rule, assuming they meet the control requirements.
So flow through to C Corp is generally manageable tax-wise.
Generally, yes, not
Yeah.
usually a major taxable event.
Okay, what about the other way? Going from a C corporation to a flow-through entity, is that easy too?
That's where it gets much more complex and potentially much more expensive from a tax perspective.
More costly. Wow.
Well, a C corporation can elect S corporation status if it meets all the S corp eligibility rules. That conversion itself isn't usually a huge tax hit, although there can be lingering issues like the built-in gains tax for assets that appreciated while it was a C corp.
Okay, C to S is possible with some potential baggage.
Right. But converting a C corporation directly to a partnership or a sole proprietorship, that typically requires liquidating the C corporation first.
And we just talked about C Corp liquidations.
Exactly. It's generally treated as a high-tax event. The C corporation recognizes gain on all its appreciated assets upon liquidation, taxed at 21%. Then the shareholders recognize capital gain on their stock based on the value received minus their stock basis.
The double taxation hits hard on conversion.
It can, yes. It's essentially like selling the entire business from the C Corp to the shareholders, triggering tax at both levels on all the built-up value.
Yikes. So that raises a really important strategic point, doesn't it?
Absolutely.
If you're not 100% sure about your long-term structure, or you want maximum flexibility to pivot later without a massive tax penalty.
Then starting as a flow-through entity like a partnership or an LLC taxed as one generally gives you much more flexibility. Going from flow-through to C Corp is relatively easy and cheap. Going from C Corp back to flow-through can be very, very costly. That potential future conversion cost should definitely factor into your initial choice.
Forethought about flexibility seems key.
Eh.
Eighth, the big picture. A quick reference for tax advantages. Okay, that was a lot of detail. Let's try to pull it all together. A quick recap, focusing on those tax-saving opportunities we've uncovered, like a cheat sheet for entity choice based on tax advantages.
Good idea. Let's summarize the most advantageous entity types for those key tax characteristics we discussed. Remember, context is everything, but here are the general tendencies.
All right. First up, contribution of appreciated property. Putting valuable assets in at the start without triggering tax.
Generally favors partnerships or sole proprietorships. Much easier non-taxable exchange rules, no tough 80% control requirement like core.
Got it. Next, taxation of business entity income. The ongoing tax rate on profits.
Highly situational. If owners are in lower individual brackets and active, an S corporation often wins. You get the QBI deduction, avoid SE tax on flow-through income. But if owners are in the highest brackets and plan to retain earnings, a C corporation can be better. That 21% flat rate is appealing, and double tax is deferred.
Okay, it really depends there. What about self-employment tax specifically?
Clear advantage for S corporations. That flow-through income generally isn't subject to SE tax, saving owners potentially 15.3% compared to active partners or sole proprietors.
Huge savings potential. How about the qualified business income, QBI deduction?
Available only to flow-through entities, S corp, partnerships, sole props. Big advantage for them, C corp don't get it.
Okay. Deductibility of business losses, especially early on.
Flow-through entities are superior. Losses can offset owners' other income immediately. And within flow-throughs, partnerships often have an edge over S corp because partner basis includes entity debt, allowing potentially larger loss deductions.
Right. The basis boost from debt. What about owner compensation and fringe benefits like health insurance?
C corporations generally offer the most advantages here. Deductible salaries, deductible employer FICA, and tax-free qualifying fringe benefits for all shareholder employees. S corp and partnerships are less generous with tax-free benefits.
Z Corp wins on benefits. Finally, operating and liquidating distributions, especially with appreciated property.
Partnerships are usually most favorable, typically no entity-level gain recognition on distributing appreciated property, and distributions often non-taxable up to the partner's higher basis. Much more tax-efficient for getting assets out.
Great summary. That really highlights the specific strengths of each structure for tax savings. Outro. So what does all this mean for you listening right now, whether you're just starting out or already running your business? It means that choice, that initial entity selection is not just checking a legal box, it's an active, ongoing financial strategy.
Absolutely. A living strategy.
Every single dollar you save on taxes,
Yeah.
that's a dollar you can put back into your business, hire someone new, expand, or, just keep in your own pocket.
Right.
Understanding these complexities, these nuances of tax law, turns them from something scary into, powerful tools for your financial success.
Well said. It's about empowerment through knowledge. And that raises the final critical question for you, the listener.
Yeah.
How will you use this knowledge? How will you apply these insights about contributions, income tax, losses, compensation, distributions? How will you ensure your business structure is truly aligned with your long-term financial and tax goals?
Right. Thinking about your income, your plans for profits, retain or distribute, your risk tolerance, the assets you hold.
Exactly. Making that informed choice today or reevaluating the choice you already made could genuinely make a massive difference to your financial outcome down the road. It determines how much of your success you actually get to keep.
A powerful thought to end on. That's it for this deep dive into the crucial tax implications of business entities. We really hope these insights help you make smarter, more tax-efficient decisions for your venture.
Hope it was helpful.
Until next time, keep learning and keep thriving.